Thank you so much for joining us here today for AlphaCore's Market Update webinar. My name is Madeline Hume, and I'm an Associate Director of Research here at AlphaCore. For those of you that might be less familiar with us, we are a registered investment advisor headquartered in La Jolla, California, with offices scattered across the country. We are a full-service wealth management firm that combines comprehensive wealth planning with a dedicated investment research team, of which myself, David, and Eric are members. And we help construct portfolios that we hope will help meet your financial goals by combining these two pillars. We're going to be a little bit light on housekeeping today, but I did want to remind everybody that we are going to have Q&A throughout the webinar. So please feel free to go ahead and submit those questions, and we'll address them as they come up. And with that, we'll go ahead and get started. Where the market stands today. There's been a lot going on in the news, and we've been receiving a lot of interest in what's been happening. But what's been interesting is that 2026 so far has represented a continuation of some of the themes that we saw last year, as well as the emergence of some new ones. Eric, I think it was just a few short weeks ago that we were covering the 2026 outlook and remarking on what a remarkable year 2025 had been. So I'm curious to hear your thoughts on what has extended into this current environment and what's different.
Sure. Thanks, Madeline, and welcome everybody. Thanks for joining us today. We talked, about 2 months ago now, David and I, at what an unusual year 2025 was, that so many asset classes performed at or above expectations. And in some respects, we've seen similar themes early in 2026. For example, gold was the superstar last year. It was up well over 60%. You can see here on this chart, it's up almost 18% this year. International markets performed extremely strong last year and outperformed the US for the first time in over a decade. We've seen a continuation of that early in the year. One big change early this year is the Magnificent Seven that have really led the market in 2023, 4, and 5 have been disappointing this year. The Magnificent Seven are down about 7% year to date, and the rest of the 493 stocks in the S&P 500 are up about 3% year to date. And what that all shakes out to is an S&P that's roughly flat. And one of the things we've really seen is a broadening out of the market this year, which was something we talked about a few months ago that we thought could play out this year. And we've seen that. And I think there's a couple of reasons for that. One is there's, I think, a fear amongst many of the Magnificent Seven stocks that perhaps there's overspending on artificial intelligence. And we'll talk a little bit about AI and spending in a bit. And that has driven money into other areas of the market, not just internationally, but in the US. I think the other thing is there's definitely a run it hot economy right now, where between fiscal stimulus and monetary stimulus, you have a very run it hot economy. And that is leading people to say, let us buy cyclicals, let us buy energy stocks, things like that. So we've seen other areas of the market perform well this year. Obviously, we've seen some weakness in Bitcoin and the cryptos again this year after a tough year last year. And you also see here publicly traded private credit, which we'll talk today about private credit. It's obviously been in the news a lot, has been challenged this year. And then the last thing we see here is hedge funds, which have really had, I think, a reemergence in investor portfolios, something we really like as a stabilizer in portfolios, continue to perform strongly after a very good year last year.
Great. And Eric, one thing I think here on the research team that we benefit from, and certainly across the rest of the firm as well, is your previous experience investing in technology companies and focusing on enterprise software. And one of the things I've heard you say is that this is one of the craziest markets for tech investing that we've seen since the dot-com bubble and burst of the early 2000s. And I'm curious how you think about this environment when the S&P is basically flat, almost unchanged since the beginning of the year. What's going on, and how is that even possible?
Sure. Well, if you look at the next slide here, what you see is there's this concept of dispersion. So essentially, dispersion means that stocks aren't behaving the same, and different stocks behave differently. We see on this chart here on the far right, the reason that line is so high is that individual stocks within the market itself, the average movement there has been 7 times larger than the movement of the market index. And we haven't seen this divergence since 1994. You also have where about 60% of stocks in the S&P 500 are outperforming the index. So for those of you who may not know, the S&P 500 is what's called a market cap weighted index. That means that the largest companies, such as the Magnificent Seven, have a greater impact on total performance than the smaller companies. And so that's how it's possible for the index to be flat on the year when you have 60% of the stocks actually up on the year. And so what happens is when you have very low index volatility and very high individual stock volatility, that's called high dispersion. And we've seen this across sectors. And it's not just software. Certainly software is an area where we've seen it, but a lot of it is being driven by, I think, individual investors trying to figure out the impact of AI on the stock market and on individual sectors, and how is it going to impact companies, what sectors might do well, what sectors might not do as well. We've seen some recent thought pieces out from different research firms that have made some hypotheses about where AI might go over time, and we'll talk a little bit about that. But I think it's really notable that we've seen this broadening of the market, and we've seen dispersion, again at 30-year highs.
And I want to talk about those research pieces, Eric, for just a little bit, because it's really unusual to have these kind of generalized economic analyses actually start to move the prices of individual securities, right? Normally you see it's management, announces an earnings miss or gives bad forward guidance, and that's what causes and introduces individual stock level volatility. But this level of uncertainty is creating these market moves that have origins and things that we're not quite used to seeing. So can you talk about what the market is responding to here and what we see when we're looking at the data and how it may exist in dialogue with these views that people have?
Sure. Well, I think one thing we all have to remember is that markets are forward-looking, and they tend to look at future cash flow expectations, future GDP growth expectations, and when the market is uncertain, that window narrows, and the willingness of market participants to be forward-looking is much shorter than when uncertainty is low. And so lately, we've seen a lot of fears of AI disrupting multiple different sectors: enterprise software, financial services, trucking, where a karaoke company changed to become a AI company and disrupted stocks on a given day. And so we've seen a lot of market reaction because of this fear and uncertainty. And this is not uncommon. We saw this in the late 1990s when the internet first came to be and really took off. We saw this in particular in technology when the software as a service model came to be in the mid 2010s. And so, there's been a lot of fear lately about AI is going to eliminate all these jobs. And in particular, we'll all just do all of our own coding. There's this concept called vibe coding, which is the idea that we can write our own code, even though we're not coding experts. Well, here's the data. And one of the things that we talk a lot about in our team is that we want to look at facts and data when we make decisions. And we understand that human nature can also drive stocks in the short term, but over the long term, it's facts and cash flows that drive stocks. What this chart here shows you is that over the last 6 to 12 months, job postings for software engineers have accelerated dramatically and returned to a level that we haven't seen in several years. That belies this notion that we're all going to do all of our own coding and we don't need software engineers anymore. Now, there may be different skills needed in the software engineering community, but the idea that we're not going to need software engineers, I think this data right here shows you that that's not necessarily the case.
And Eric, this is true in software, and it's probably true, David, in other industries as well, as you think about in the broader economy, the impact of AI on the complexion of the labor force and how it could influence what people actually do day to day, and how that exists in dialogue with how many people are actually employed. So how do you think about those factors and how this could play out over the next couple of years?
Yeah, absolutely. And hi, everybody. I think that we absolutely understand that AI is going to be transformative for many industries. The history of technology, kind of waves coming into an economy is usually one where it augments labor and it enhances productivity. There are eventually some implications for joblessness and for labor markets. Usually the adoption of a technology is slow enough for markets to react in that way. We certainly have been talking about the productivity pickup from AI since I joined the firm only 8 or 9 months ago. It is a key part of the outlook, but I think that some of the more dramatic takes on how quickly this could impact the labor market and what would happen then, I think underestimate the frictions of adoption. Those frictions usually come because of the societal consequences, the everyday politics of implementing new technologies and organizations in both the public and the private sector. I think as well there's a natural break on AI's adoption that's about to start to bite, and that is the constraints on the build out of data centers. We see limitations for land, for energy, for power connections, for things like turbines, for cooling systems. That the AI kind of build out really could be limited by those things, and therefore the price of the AI services would rise, and therefore any kind of substitution of labor would slow. So I think there's a few things here which point to us that this is going to be manageable. But at the same time, we would expect there to be some types of policy responses as well, to the biggest consequences. Overall, this seems to be something that's pro margins, pro growth, pro profits, and pro productivity. The question is just what will be the impact across society. At the moment, I think next few years we believe it's going to be manageable.
Well, and I think that's a great point to expand into another related area, which, when we look at stock market volatility and when software stocks are crashing as much as they are, it's partially because analysts are looking at the terminal value of these companies, right? 20 years down the line, maybe 15 years down the line. But we even see it starting to impact investments that occur over a shorter time horizon, right? And I'm thinking of private credit here, where these firms are making loans to companies over a 3 to 5 year time horizon. And David, I think we're really lucky in that prior to joining AlphaCore, you were partially part of the committee that was an architect of one of these solutions at Blackstone. And on the front lines of a lot of this boom in private credit, as some people have dubbed it. And now you're starting to see people question the other side of it. Is there a bust on the other side? And so I'm curious to hear how you think about it, what investors are questioning with respect to software exposure within private credit, and how you see it.
Yeah, certainly that private credit is the majority of private credit is something called direct lending, which is where a creditor, a firm, one of these large alternative firms like Blackstone, like areas like Blue Owl, is providing credit to a private equity sponsor to take over a company. Now, private equity sponsors do love software. They like it because it's asset light, usually has recurring revenue, and therefore you do find significant exposure in private equity portfolios and in private credit portfolios, to software. I think that that's why I think there's some focus here on private equity and private credit. At the same time, these organizations are keenly aware of the possibility and the danger of disruption. They tend to invest in enterprise software, number one, which tends to be the backbone of companies, tends to utilize and provide proprietary data, tends to be very, very hard to move on from there as well. I think also private credit is often seen as a replacement to liquid markets. I think that underestimates, I think, some of the levers that these organizations can pull. They can work very closely with the private equity sponsors. They can alter terms. They can assist in actually the running of the company. And therefore, I think that there's plenty of levers to impact the underlying health of the investments as well. I think overall, we spent last year talking about private credit, whether it was a bubble or not,
right.
and we pushed back on that. It's certainly been an area of incredible growth, maybe the fastest growing space in investing. We continue to believe that this is a structural change in the financial system, right? That this was deliberate. The re-regulation of the financial system after the financial crisis, and most obviously the Dodd-Frank Act in 2010, deliberately moved this type of lending out of the banks, and you don't want it in the banks. The banks are obviously the backbone of the financial system and the payment system, etc. So that's what kind of fueled these alternative lenders stepping in to fund these transactions and to fund these companies. For us, that's a structural change, a structural improvement in the financial system, and the investment surge into private credit is simply a result of that, the second order effect of that. Despite all that, it's very clear a lot of money's gone in, a lot of new players have gone in. By some measure, there's more than 1,600 private credit funds available in the US today. We engage with just a handful of the most senior, largest, most sophisticated most established players when we implement private credit in portfolios. So I think you could say two things at the same time. One is that we believe that the type of top tier private credit that we're investing in is a core asset class that's going to play a role in portfolios on as far as the eye can see. And at the same time, there could be a shakeout in parts of the private credit industry, and that maybe the torrid growth that we've seen will now slow. Similar to how the assets that moved into private real estate also slowed after the interest rate shock that we saw a few years ago, and that caused some tough times in private real estate. So absolutely, maybe we're moving past this initial surge stage of private credit, but it's very different to say that there's something structurally wrong with the asset class or that it's particularly vulnerable right now.
I think that's a great point, and I'd love to stay on that topic for just a second, David. You mentioned real estate as somewhat of a test case in how these cycles play out from an outflow perspective. So I'm curious, given that you were at Blackstone at the time and experienced that on the ground, what were some of the key lessons from that? And Eric, I'd love for you to chime in here as well.
Yeah, just briefly. So obviously, I was at Blackstone when on the private credit side, BCRED was their fund was growing so much. At the same time, their flagship private real estate fund was in what was called proration. That is when investors were asking for redemptions over the cap that the firm had set for those said redemptions. Now that obviously creates some challenges. You're trying to provide liquidity back to to investors, and you're doing it at the same time that the underlying asset class had some stress. We all know that when interest rates increased, it pressured real estate values, especially those with weaker fundamentals. So things like your average office in a second tier city in the United States, other places that have seen very significant increases in supply like biotech, office, and indeed ultimately multifamily. I think the lessons now obviously you take a step back and you realize that after 14 months, the fund had met all the redemptions and was no longer in proration, and since then has returned to growth. And overall, the fund did a tremendous job of maintaining investor value. I think the lessons are that it's really not just about the actual kind of rules around the structure; it's how you operate it. It's the amount of liquidity provisions you have in place before tough times arrive. It's the quality of assets you've amassed before the tough times have arrived. It's how clearly you communicate with investors. It's the trust and relationship and reputation you have with investors. And then it's the ability, when you do need to sell assets in potentially a difficult market, to source the right buyers, to have that reputation, to have that network, and to find sources of liquidity to meet those redemptions. I saw Blackstone do that tremendously. I have no doubt that most of the large players are going to navigate any other situation like that very well. But I understand that investors have not been through that. Will obviously have questions as they're going through it. We think this is how the system's supposed to work, how the products are supposed to work to protect the value, to prevent forced selling. And I think we're going to see private credit go potentially through something like that in the next couple of quarters.
The 5% liquidity provisions, or it can be different depending on the fund, that is a feature of these products, not a flaw. It was an intentional feature of the products to allow individuals to invest in products like this, and yet if individuals wanted liquidity, to protect the entire portfolio itself. I think it's clear that, as David said, you've had a lot of money come into private credit in the last several years. The industry's grown a lot. That means a lot of new funds. Inevitably, some of that money was likely put to work into loans that will not perform. That's credit lending. The other key component here is many of the loans that you're reading about in the press that are getting into trouble were made between 2020 and 2022. And why do I bring up that time frame? Because that was prior to interest rates returning to more normalized levels when the Fed raised rates 5.5% to fight inflation. And these are floating rate loans, meaning just like an adjustable rate mortgage, the rates on them adjust as rates move up or rates move down. And so if you took out a loan as a large company being bought by private equity in 2021 or 2022, you very well may have gotten a loan at 6 or 7%. You see back here, maybe it was 8%. And that loan then went to 12+% by 2023. And that is a substantial increase in interest expense that your business may not have grown fast enough to cover. And so I think one of the things you see in this chart here is that rates have moved up and now rates have moved back down as the Fed has been cutting rates. But one of the key things is direct lending yields, which is what you're receiving in many of these private credit funds, have a premium over syndicated loan yields. Syndicated loan are publicly available loans that banks are making. And that premium has remained pretty constant over the last almost 15 years as this industry has grown. And we think that's important because one of the things we believe is that if you are going to be in a less liquid investment, you should receive a premium for being in that less liquid investment. And importantly, you've continued to receive a premium in private credit over that time frame. And I think the other thing that's critical is we pride ourselves on the research that we do and the due diligence that we do across our team. And so we spend a lot of time talking to these managers, going through portfolio statistics, going through industry statistics, and we continue to watch that. And I know there are headlines out there about different loans failing or loans being written down. And again, I expect that there will continue to be some headlines around that because you've had so much money go into this market. But at the same time, we remain vigilant. We are on top of this as a team, and the managers and the allocations that we have, and the data and the statistics, which again, we focus on data, we focus on real cash flows and information, remain at very manageable levels across these portfolios.
Great place to transition, Eric, and maybe to put a finer point on that. One of the things we did in the fourth quarter of this year across the coverage that we have in our private credit book is take a look at flows and see where our managers stood from a liquidity perspective. And I think one thing that gets overlooked with a lot of the headlines, we saw Blackstone announced maybe within this past week that they were going to be redeeming 7.9% of their shares. And that's a fairly high number. But when we look at the full picture, that number is also should be considered within the context of there's also money coming into these funds. It's not just about redemptions and money getting pulled from the fund. You have flows going in as well. And so the net effect is what we're looking for to assess these managers' ability to provision for liquidity. And so through the fourth quarter, we heard a lot of headlines around that period. Some vehicles had redemptions in the range of 4.5%, and they got up to 17% in some really unique situations. But in most of the funds and managers that we spoke with, they were actually in net inflows during that period, meaning that they were taking in more money than they were paying out. We don't expect that to continue as this outflow cycle extends. It would be reasonable to expect that trend to change. But at least for now, what it means is that going into this cycle, managers could shore up their portfolios and make sure that there was ample liquidity to meet this moment as investors are requesting some of their money back. Anything else on private credit, gentlemen? I know we've got a lot to cover today, but I want to make sure we hit this home.
I mean, I think. Go ahead, David.
Just to say, well, again, the lesson from this chart is the premium over liquid fixed income has been reasonably consistent, around 2.4%. That is known as the illiquidity premium, right? And as Eric said, the limits of redemptions are a feature there, and so clients should go in to get that premium only if they can invest in the kind of medium term and not want to instantly move up money in or out.
Yeah.
And I think that's the what we balance in client portfolios. That's why the conversation and the wealth planning side is so important. How much liquidity do you need? Are you planning to make a significant purchase in the near future? And again, private credit is a great tool only when when deployed inside of a robust wealth plan, and that's what we're trying to do.
Yeah, I think maybe one other thing to address. Obviously, there's been a fair amount of press about a number of the large alternative asset managers, Blue Owl, Ares, Blackstone, KKR, so on and so forth. Just to frame that for everybody on the call here, these managers are managing anywhere from $200 to $300 billion of assets to, in the case of Blackstone, over $1 trillion of assets across many different strategies, including private credit, private real estate, private equity, sports media and entertainment, so on and so forth. And we allocate in some cases to a real estate fund at a manager that might also run a private credit fund. And it's important to distinguish, these are separate groups. They have separate teams, separate assets, separate funds that that are raising at different times. And even within the private credit areas, again, these are strong portfolios. They've continued to see net inflows. I don't know if that will continue throughout the rest of this year, given negative headlines, but these portfolios have proven to be strong. Blue Owl was, this is in the press, that they recently sold a very large chunk of loans at near 100 cents on the dollar, I think, indicating the underlying strength of that portfolio that they sold.
Okay. And with that, I'd like to shift gears a little bit. Some people have labeled private credit as a quote unquote boring asset class most of the time. Obviously, when there are headlines about it, that's not quite the case, but compare that to what's going on in Iran and the rapid pace of developments in the geopolitical sphere here. David, I'd love to hear your latest thoughts on the conflict, how it shapes the battleground in the Middle East, and what we should be thinking about as we assess the landscape.
Sure. Well, I think it's obviously the latest demonstration of the muscular foreign policy of this presidency and the desire of this administration to move unilaterally when it perceives that there's a national interest at stake. Obviously, we've seen wars in different parts of the Middle East over the last couple of decades. The playbook market-wise is that there's a fear over energy prices. Initial spikes. There was certainly one this time around. There was another, of course, in Russia, Ukraine, and of course, if you go back to the Iraq War and others, you saw significant changes there to hydrocarbon markets. I think that this is a particularly important part of the world because of the concentration of both oil and natural gas production. Not only in Saudi Arabia, but also in places like Qatar. And because of the ability, should the Iranians choose to do so, to limit the flow of those hydrocarbons from those producers out into the world through a small part of the ocean called the Strait of Hormuz. And that is what you see up here in the chart. On the left-hand side, you see what the usual functioning of this kind of choke point. The red dots there are the oil tankers that are moving east to west and west to east through this piece of the sea, and that's obviously normal functioning. On the right hand side is what's happening right now, where you can see that they are clustered either side and not willing to go over the top of that peninsula where they are vulnerable to Iranian attack. Now, markets can take supply disruptions for a certain period of time. The biggest oil importers in the world are the ones that would be hurt by this. People like China, India, Western Europe have inventories. However, as you can see from this slide, the dramatic decline in tankers passing through the Strait of Hormuz will sooner rather than later really start to stress parts of those oil markets, and you'll see the local price all over the world start to diverge from the global price because oil can't move around. And you'll see countries start to take measures to protect their own supplies. I think overnight China announced that they're not going to export refined products. In that way, we've seen shortages of aluminium also being start to be reported. Because look, global supply chains are not optimized for war; they're optimized for peace, right? And as long as a war continues, the impacts tend to compound upon one another, and that's why. When anyone says what will the impact of the war, it'll be, I say, well, tell me how long it's going to last and tell me how wide it's going to spread. Obviously, we've seen a broad spread very, very rapidly. Attacks to many nations, including this morning, I think Azerbaijan, was attacked as well. We also see plans, potential plans to escort ships through the Strait of Hormuz, which would loosen, those restrictions on the price of oil. So this is where we continue to focus. Who is most vulnerable? Well, probably Western Europe because of their enormous, appetite for natural gas and the fact they get a lot of it from Qatar. Who is the benefit here? Well, the U.S. natural gas industry is benefiting because they're obviously a very large supplier. Their lead competitor, Qatar, is kind of shut out of markets right now, and you're starting to see increased prices and profit margins out of some of the U.S. producers. That leads me to the final point on this kind of small section, which is the U.S. is very insulated from this. The U.S. has a lot of domestic hydrocarbon assets. It's reasonably energy independent. It sells some types of energy out and buys some types of energy in. We won't get into the details, but bottom line is, the impact on domestic U.S. energy markets is fairly light. The impact on other trade flows is fairly light. The U.S. doesn't import a vast amount of other goods from the Middle East. So domestically, there could be some minor impact on inflation, but it doesn't seem to be a significant driver. Other parts of the world much more exposed to this. Yeah.
Fascinating. And so that is the kind of diffusion of impact from the energy markets perspective. Eric, I'm curious to hear what the equity markets are watching as this conflict unfolds and what potential catalysts could be from an energy security perspective and what the biggest risks are that we're currently keeping tabs on.
Sure. Well, a lot of times we get asked, why is the market not reacting more negatively to various geopolitical events? And I think if you look back historically, major geopolitical events, World War II, Vietnam War, 9/11, things like that, the market tends to react negatively over a short period of time, and then it tends to come back because at the end of the day, markets value individual companies. That's what makes up the price of the market. Those companies generate cash flows. And so the question is, how are their cash flows impacted or not by geopolitical events? In this case, as David just outlined, the US in particular is fairly isolated from a lot of what's happening in the Middle East right now, at least from the standpoint of our corporations and their earnings and cash flows. And I think that's one reason why our market is held up pretty well right now. I think one thing that we are paying attention to David's point, is not just the duration of a potential upset here, but if the infrastructure that produces energy in the Middle East were to be taken offline through attacks for an extended period of time, even if it only impacted Western Europe and perhaps China, it is an inflationary item because more than likely Western Europe would try to buy more LNG from the US. Our companies are free to sell that LNG, so it could potentially be inflationary. I think the market will pay attention to that. You've seen some impact on US yields recently. So, you know, those are things that we're paying attention to. I think what it really highlights is this is why we encourage fully diversified portfolios. This is why we encourage portfolios that have stabilizers in them, such as hedge funds and other stabilizers, private infrastructure, that are there at times when public equity markets can be more volatile. David, I'm curious your perspective on what we're seeing internationally. You mentioned that China and Europe and whatnot might be more exposed. How do you think that impacts this dynamic that international markets have been outperforming the US, you know, over the last 15 months or so? And I think we believe that could continue for some period of time. But how are we thinking about that dynamic right now in the context, as you mentioned, that they're potentially more exposed than the US is to these events?
Yes, I think it certainly doesn't help the immediate outperformance. I think, though, the case for further outperformance is based on one, valuation. The market's looking a little, at least optically, cheaper outside the US. Secondly, the elevated level of the US dollar up until very recently, that had been very strong. It had 10 to 12 years of strength up until last year, and then potentially a rotation away from some of the more tech focused markets like the US and into other markets where you see greater shortages across, say, manufacturing, etc. I think that the big question about whether this is really going to damage the economies again is the duration of the price spike. Again, a short-term spike is not going to be a big deal. I think also it's about whether there needs to be a policy response or not, right? And that would usually be from the central banks if they really feared a sustained inflationary impulse. So again, remember the Russia-Ukraine incident came at the worst possible time for macroeconomics and for inflation, because we already had a modest inflation issue coming out of COVID, and then the Russia-Ukraine war broke out, and you saw, as you see on this slide, a sustained increase in energy prices. That was much worse in Europe because they're much closer to the conflict, and they imported a lot of their energy from Russia, which they tried to stop to do. But it wasn't helpful for anyone, and indeed it necessitated a faster and larger increase in interest rates from central banks around the world. I do think the situation we're in now is very different from then. Inflation, certainly in Europe and in China, is at or below targets. If you're their central banks, you're going to say, okay, I can look through this. I don't really need to react unless this goes on for a very long time and is much larger than we currently see today. And again, on this chart, you see that it can take a little while, a few weeks, for markets to fully process a sustained shutdown in hydrocarbon supply. I would say that the US is in a slightly more difficult position because inflation has not come down to target. It's bouncing around close to 3%. There's certainly many members of the Federal Reserve who are very concerned about the inflation outlook. We obviously have a new Federal Reserve chairman coming in only a couple of months. A sustained energy price spike, which did impact US markets, would be a little bit more awkward for the Federal Reserve, that has reduced interest rates quite significantly despite inflation not being back at target. So I think at the moment, directly to answer your question, Eric, I don't think this is going to materially disrupt the international economies as long as it's brief. I think the central banks will be able to look through it for at least a couple of months. But no, everyone's life is going to be made more difficult if this is still an issue, and indeed if it compounds upon itself a few months out from now.
So we're getting a few questions in the Q&A section, and I would encourage everybody to submit, and we'll open the floor up for questions. But maybe to synthesize some of the ones that we've seen so far, people are asking about the implications of this conflict and US foreign policy on our relationship with other foreign powers, and specifically China, how it might change in the short term and how it might color other elements of foreign policy that might not be so directly related, such as our stance on imports of crucial chips and semiconductors, other things that might influence our competitive positioning in AI.
Well, I'll take a shot. I'll say that this is more a reflection of where international relations is at, rather than something that's going to change them. And where they're at is that we have seen the near total collapse of the rules-based order, the architecture of international rules across international relations that was often driven and set up by the United States. Now, that didn't happen overnight, but it's certainly been going on. You could trace it potentially to the Iraq War in 2003. You could certainly trace it to the failure to confront Putin or Assad after their military adventures in the early 2010s. You can then also trade it to the election of Donald Trump in 2016, and again, obviously recently, on a platform of isolationism and removing America from many of the global institutions that it helped build. And I think that when you also layer on the aggressive tariff and trade policy that we've seen, not just against strategic competitors like China, but also allies like Europe and Canada, I think it shows you where we're at internationally today. Certainly, we are living in an age of impunity where large powers like Russia and the United States can wage military conflicts on countries with no consequences. And we will continue to live in that age. That comes with, I think, a systemic breakdown in trust between many nations. Trust between the US and China, I think, has been fragmenting for a while. You could say that's justified given some of the behavior of the Chinese when it comes to intellectual property, for example, and certainly the rise of our perception of China as a strategic competitor, and our desire now to create resilience in our trading system by moving away from dependence upon them. You could say that that's been going on for a while. What's been going on less long is obviously the fracturing of the Atlantic relationship with our European allies. And as the United States has weaponized Europe's dependency through military technology, through civilian technology, you start to see a world now where the world is fragmenting and starting to go to the question for everyone to be looking after themselves and also trying to secure domestic supplies of everything from energy to military materials to semiconductors. And so I think that this military action, which of course occurred with no other ally apart from Israel, which wasn't even a discussion at the United Nations, just illustrates the type of world we're in, the world which this president has taken us in, and a world I think we're going to remain no matter who is in charge of the major powers in coming decades.
And as we think about the fracturing of the global supply chain and kind of the end of this era of globalization, what are some, I'm curious to hear from both of you, of the key investment themes and sort of, resiliencies built into portfolios that are especially important during this time?
I'll say a couple of things and hand over to Eric. I mean, the obvious one, of course, is you invest in defense companies, right? If the world is going to rearm, and certainly countries like Europe need to rearm and need to play a bigger role in their own defense, you would invest around that. Companies that are focused on the kind of onshoring of supply chains in general around crucial materials, be it semiconductors, healthcare products, biopharma, etc. And then lastly, for me, we have emphasized infrastructure. We have shortages of energy. We have shortages of other key infrastructure assets. And those shortages are present in almost every developed economy right now. So there's a few. Eric?
Yeah, I think certainly infrastructure would be right at the top of the list. It's something where we've really been trying to invest in the picks and shovels of what's going on in artificial intelligence around energy infrastructure, digital infrastructure. I think we'll see continued investments, as David said, in transportation infrastructure. So that's certainly something. It's also a non-correlated asset. So it's an asset that doesn't behave the same as many other assets in your portfolio, such as public equities. That's certainly at the top of the list. I think another theme that we believe has begun to play out and will continue to play out in this reshoring and changing of global supply chains is that there will be a lot more investment by developed countries like Western Europe, the US, in areas like minerals, metals, mining, things like that, where we have really foregone those investments for decades, and the Chinese have taken over that part of the supply chain, and it's made it very difficult for us, especially over the last 18 months in the trade war we've been in, to get access to things like rare earths, which is a misnomer because they're not actually rare, but that's the nomenclature for them. They are a little bit challenging to get out of the ground. So I think you're going to see a lot more around that, and we're focused on how do we build on that. I think certainly what we've seen with gold will continue to be an area that will be a diversifier in portfolios with structural deficits, not just in the US, but really throughout the globe. So there's a lot of different areas. And then, public equities will be there. And David talked about some of the areas that are potentially interesting. AI is going to be a theme in both public and private markets, and it may go up and it may go down in individual stocks, but we are seeing hundreds and hundreds of billions of dollars just in the US alone going into AI, and we continue to look for ways such as private infrastructure and some public equities to play on that theme as it plays through the economy.
If I could just comment, I think Eric's absolutely right. I think a way to think about this era of investing is one where things that were stable are now creating shocks. You can say that one of those is the geopolitical environment. 20 years ago, I think things were very different. Now we see shock after shock after shock when it comes to, say, Russia, Ukraine, trade wars, and now obviously Iran. Same thing that you could argue with the climate. 20 years ago, the climate seemed to be stable. Now we see all kinds of evidence of the growing climate crisis that affects markets through inflation, through supply chains, damaging transportation corridors as well, and that often feeds back to inflation. And then at the same time, we have a gigantic technology shock, right? Mm-hmm. Now, technology is always moving forward, but there are clearly waves that come into society. AI looks to be an enormous wave that's starting to hit us right now. And so I think that it's not just what you're investing in, it's how you're investing in it. Mm-hmm. The very core of AlphaCore's philosophy is to invest across public and private markets, traditional and alternative asset classes, equity and debt, and to do so in a way which tries to create resilience in portfolios. And resilience is the word, right? We all like to say, to have a great return, and we're trying to aim for that. Of course we are. But given that we are in an era of these overlapping shocks, which are not going to stop, the really resilience is the key word when we think through portfolios for clients.
And to maybe take, a cue from your podcast, David, which has just recently launched, called Upside Capture, looking at the upside of this, there is the opportunity for great value to be added through active management and through risk management. I think that we see this when we speak with our managers and we talk through some of the opportunities that they've seen. To Eric's comments earlier, dispersion creates a difference in outcomes that smart, capable managers can hope to exploit. And we on the research team are working very hard to find those managers and to hopefully express them in our portfolios. So to maybe kind of conclude and wrap up with some key thoughts that summarize some of the things we've been talking about here, markets are forward-looking. And when there is less certainty in the outlook, which we definitely see in today's environment, time horizons for investors and analysts start to narrow. And this results in greater price volatility, which, as David has been talking about, hopefully is a time when diversification shines. The other thing to keep in mind is that AI is going to shape the future of our labor market. But the thing is, nobody really yet knows how, or more crucially, over what time frame that will occur. And in the meantime, we know that it's going to take a massive amount of capital and a build out of our power and data infrastructure in order to support it that we don't currently have today. Thirdly, we see headlines in private credit almost daily now, but we would remind everybody that these are, individual situations that when taken in aggregate are difficult to generalize. Nevertheless, we expect in general for elevated redemptions to continue. And these are semi-liquid investments that are meant to be held for the long term. And so we hope that these are considered a core strategic part of investors' portfolios, aligned with their time horizons and liquidity needs. Geopolitical events tend to fade quickly in the market's consciousness. However, in the current instability that we're in, we don't know how long it may last, and it may last for some time, which, as we've discussed, may create some modest inflationary impulses via higher oil prices. But gentlemen, I'd love to ask you both for some of your concluding thoughts. This has been a great discussion. I'm really excited to hear, what you all think.
Eric, I'll let you go first.
Sure. Well, first of all, I want to thank all of the participants today on obviously such short notice to host this webinar. We hope that you have some takeaways from this. I think my takeaways are, generally speaking, despite all the noise that we talked about and the shocks and everything else, markets continue to do well, and they're doing well because the economy is doing well. And ultimately, it's really about the economy and cash flows. And I think my other takeaway here is, remember that diversification is important at all times. And that's one of the reasons that we focus on these customized, diversified solutions for our clients.
Yeah, I would just echo that. If you look at the private sector of the United States, the household balance sheets and the corporate balance sheets, they've never been stronger. And there's plenty of ways to invest around those. If you look at some of the big issues that parts of the international economy have had in the last 10 to 20 years, a lot of them look like they are getting resolved. Japan is emerging after multiple decades of stagnation. The European financial system was moribund for 15 plus years, now looks to be healthy and supporting growth again. The commodity sector looks set for strong demand into limited supply. We could see significant moves up, up there, as well. So there's plenty of things to invest in both here and around the world. How you invest in them will matter just as much as what you invest in and constructing those portfolios. And we're here to have those conversations if you ever want to pick up the phone.
All right. I think with that, we're going to wrap. Thank you, everybody, so much for joining us here today. And as always, if you need to reach us, feel free to contact your advisor and we'll put everybody in touch. Thank you so much. Take care.